Hello traders, and welcome to our Babypips course. For today we are on course 6 of 11 high school. We've concluded trading divergences, market environment, and today we're going to consider trading breakouts and fakeouts. So let's go to grade 11, trading breakout and fakeout, and here are the subtopics under trading breakouts and fakeouts: how to trade breakouts, how to measure volatility, types of breakouts, how to trade breakouts using trend lines, channels, and triangles, how to measure the strength of a breakout, how to detect fakeouts, fade the breakout, how to trade fakeouts. Then we'll have fade the breakout, okay, and then we'll have summary, trading breakouts and fakeouts. So let's begin with the very first one: how to trade breakouts. And so how do you take advantages of breakouts? Unlike the stock market, you know when to enter into a breakout because of the volume of a trade. Okay, first of all, let's begin with breakout. A breakout is when price breaks out or gets out or moves away out of some sort of consolidation. Okay, so when price is ranging in a particular area and it's not making a move, the time in which the price moves from that particular area, that's when the breakout occurs. So that is a breakout. Okay, so it can also occur when the specific price is breached, such as support and resistance level, pivot point, Fibonacci levels, and all that. So back to volume I was talking about. In the stock market, you can use volume to gauge breakout. Okay, like when the volume is low, there are not many active traders. Okay, and when it is high, there are many active traders. This kind of data is available in the stock market. However, in the forex market, it is not available. And in the forex market, we don't see volume, we see volatility. Okay, so volatility is what you use to measure price movement. Okay, so if the market is moving so fast within a particular period of time, we say the market is highly volatile. Okay, and so since we do not know when volatility is about to occur, and when it does occur, there's sharp movements in prices, either up or down, and sometimes it might just go up, come down, go up, like that, before it takes a particular direction. Okay, so how do you protect yourself? The only way to protect yourself, right, against this disadvantage is to use good risk management. Okay, so that's the only criteria. So if there's a price movement that is very high within a short period of time, we see the market is highly volatile. However, when there's no price movement, okay, we say there is no volatility, or volatility is low. So the only way you can be able to succeed to use volatility to your advantage is to try to be patient and wait for the market to settle. Okay, let all the noise fade out, and when the market is settled and it takes a particular direction, and then you can get into the market and ride the trade once it skyrockets. So now that we've known what volatility is, and how breakout, and how to get into it and out of it, and how best to even enter it, okay, waiting for the market to settle, let's now move to the next lesson, which is how to measure volatility. Volatility measures the overall price fluctuations over a certain time, and this information can be used to detect potential breakouts. So we use volatility to look for good breakout trading opportunities, and there are a number of tools we can use to find this out. One is moving averages. So moving averages is a very good indicator that forex traders use to measure market volatility. Simply put, moving averages measures the average movement of the market for an X amount of time, where X is whatever you want it to be. So for example, if you applied a 20 SMA to a daily chart, it will show up the average movement of price for the past 20 days. Okay, there are different types of moving averages: exponential, simple, and weighted moving averages. Okay, but we are not going deep down into them. We are only considering them in the lightweight form. So if you want a detailed explanation, go to our previous lessons where we talked about moving averages, momentum and oscillators. Okay, and I will drop a link in the description for you to watch that video. So look at this chart we have here. You see the distance between the orange line and the blue line. Okay, this is the volatility. This is when there was so much movement in price. Okay, you can see that there was so much movement in price, unlike this area here and this area here, and even this area here, there's no movement. But in that little area which we chose, which we highlighted, there's so much movement. So that's how you use moving averages to measure volatility. Next is Bollinger Band. Bollinger Bands also is a very important tool for measuring volatility. Bollinger Bands are basically two lines that are plotted 2 standard deviations above and below a moving average of an X amount of time, where X is whatever you want it to be. So let's say if you plot 20, right? If you set it to 20, we would have a 20 SMA and 2 other lines. Okay, now SMA stands for simple moving average. Now one line will be plotted 2 standard deviations above it, and the other line will be plotted minus 2 standard deviations below the 20 SMA. So when the bands contract, it shows that there is low volatility. It is low. Okay, that is O. However, when the bands expands, as you see in this area, volatility is high. Okay, so that is how to use the Bollinger Bands tool for measuring volatility. Now the next one is average true range. The ATR is also an excellent tool to measure volatility in the market. Okay, basically it takes the currency pairs range, which is the distance between the high and the low in the time frame. Okay, and then it plots that measurement as a moving average. So if you set the ATR to 20 on a daily chart, it will show you the average trading range for the past 20 days. Now looking at this example here, you see how the ATR works, and this is the high of the ATR and this is the low of the average true range. Okay, and now you see the range. You have to use a triangle or a rectangle, okay, to measure the range. This is the highest of the range and this is the lowest of the range. Okay, now when the market breaks above the low of the range or below the low of the range, you know what to do. Okay, now when the ATR is falling, it's an indication that volatility is decreasing. When the ATR is rising, it's an indication that volatility has been on the rise. Okay, so remember how it works. Here is the highs and it's fall down, volatility is going down. Now the ATR is best used as a technical indicator to confirm the market's enthusiasm or lack of enthusiasm for a range breakout. Okay, so next lesson is types of breakouts. So breakout begin with 8 rows of bricks like you see here. Okay, and all the colors from the bottom. Oh my goodness, let's just go ahead to the main stuff. Sorry, Babypips are funny. So there are 2 types of breakouts: continuation breakout, reversal breakout. Okay, I am not going to read, I'm just going to explain. Here we have a price trend making lower low, lower high, lower, not a new lower low. Okay, and then it created a new lower low, and then what happened is that price moved in this area, and what was price doing? We said this is called consolidation, right? We call it consolidation or a ranging market or sideways market when the market at the price is just bouncing within a specific level, specific high and a specific low. It's not moving out of that place. Okay, so this is consolidation. And why does this happen? Earlier the market has been on a lower, on a downtrend. Okay, so sellers have taken lots of profits in this area before they got here. So once they got here, the buyers tried to push the market up. sellers are still here. Some very few sellers are here. All this time, they are thinking, deciding which way price should go. Should we push price up, or will price continue to fall down? Sellers and buyers in the market, they are still fighting, okay, battling for supremacy. So what happens? Now let's move ahead. Now in this scenario, we have a breakout continuation, or a continuation breakout. Why do we say so? Earlier, price has been consolidating in this area. Before now, the sellers have the market, okay, creating lower lows, lower high, and price consolidated here for some time. And then what happened? Price broke out of this range, okay. It broke out here and here. Price came and broke out of this level here, and what do we see? Lower low, lower high, okay, high, and it's also coming down. So this one is called breakout. Once price moves away from this area downward, or from this level here downward, okay, we say price has broken out of the range. Here is the range. Now price has broken out of the range. So this is a breakout continuation, or a continuation breakout, whichever way you want to call it, okay. And I hope you understand this. The next one we'll have is breakout reversals, okay. And the same scenario, price has been on a downtrend, making lower lows, lower high, lower low, lower high, and price was consolidating here, okay. Now when it was consolidating, the market was relaxing, sellers were breathing, taking profits and all that, trying to enter another position. And then what happened? We say this is a breakout reversal. Why? Because after the consolidation, instead of price to continue to go down from the direction it was coming, what happened? The trend line was violated and prices rallied to the top side. So in this level here, and between this level, price broke up and found momentum to the top side. So this is a reversal off of the back of a downtrend, okay. The one we looked at earlier was a continuation off of the back of a downtrend, but this is a reversal because instead of price to continue downward, it reversed to the top side. And I hope and believe you understand it. False breakout. You know Lionel Messi very well, right? It's a formidable footballer. Now Lionel Messi, when he's with the ball coming against defenders, he can fake them out, make them to believe he's going to do one particular thing but do something else. The same way, there is false breakout in the forex market, okay. You would think the price has broken out of the range in a particular direction, and all you just see is that price will come back again. If you had entered the trade the moment you spotted the breakout, you would have been, or you would take a huge loss. So here we are. This is our levels, okay, of range. Price has been coming from the top side, okay, found support here, and see what happened. A lower high. Now we are to expect price to create a new higher low or higher high. Now price did close above this level here. If you zoom in very well, you see the green rectangle box, green candle rather, closing above, okay, this horizontal line. But what do we see? The next candle was a doji, and what happened? Instead of continuing to the top side, right, price rallied down. So here is a false breakout, or like many traders would say, a false breakout. So price broke out of it but did not continue higher, came down, created a new two double tops, okay, and price continued to fall back down according to the example we are seeing here. So take note of this false breakout, okay, and be mindful of them. Now a good way to enter on a breakout is to wait until the price retraces back to the original level, back to the original breakout level, and then wait to see if it bounces back to create a new high or low, depending on which direction that you are trading from. So let's see the example we have here. Now price has been coming from the downside, okay, and price got here and it has been going down, okay, down. So we have a trend line, and we say this is what This is a downward trend line. Okay, now what do we expect? We expect price to hit this trend line, come back down, new high like that to the downside. Okay, but instead of doing that, what did price do? Price broke out of this level here. Okay, we are saying trade the breakout, wait for it to make a new high and come back to test that new high. Okay, now price broke out of this level, created a new high here where you see these broken lines, and came back down to retest its previous highs of the consolidation area or the ranging area, and price broke above this new high it created after the breakout occurred. And then here is a retest. Price came back down to retest this same level as well, then before price finally went up. So it is at this second time that price came back to retest the new high, okay, that you have to take your entry. Here's the new high. Price broke above it, came back to retest it. Here you want to enter your trade. Here, whichever one that suits you. So I hope you understand this explanation on how to enter into your trade, how to enter a trading breakout. Wait for price. Once price is consolidating, okay, wait for price to break out either to the top side or to the downside. Once price breaks out, okay, and creates a new high, wait for it to come back to the downside, okay, retrace to this level, create a new high, come back to retest this previous high, enter your trades and allow price to go back up. Or if you are so smart and professional, once price breaks out of this consolidation level right here and price is coming back down to this consolidation level, you can enter your trade here and ride it up. Okay, so this is the way to enter and trade breakouts. The downside to this is that you may miss out on some trades in which the price moves quickly without any hesitation of coming back for a retest. So now we'll go to the next lesson, how to trade breakouts using trend lines, channels and triangles. So here we are on how to trade breakouts using trend lines, channels and triangles. Spotting breakouts is not that difficult, okay, with a little practice. No, so just like your face, there are different parts of it, okay. You can use that pattern as well to understand how breakouts work. Now, by now you already know chart patterns, okay, and here are a few of the chart patterns. We've discussed all this before: double top and double bottoms, head and shoulders, triple tops and triple bottoms. Okay, now the foremost tool we're going to consider in understanding breakout is the trend line, and I'm just going to click at this picture and explain. The idea behind the trend line breakout is that one of two things will occur. Price will either come back to the trend line, okay, and fall back down, come back to the trend line and fall back down. So once you see a trend forming, okay, draw your trend line, and once you've drawn your trend line, wait for prices of the market to get to your trend line. Once price goes to your trend line, right, take an entry. You can enter here or even here. Once price falls back down, you can close your trade here. But if you want to hold a long trade, wait for it to come back to your trend line, and price consolidates and what, falls down again and again. Okay, so you can hold this trade from this region here down here, okay, and in fact that's the best way to trade. Hold your trade, take a good entry, move your entry to your stop loss, and just hold the trade and see what happens. Okay, it's gonna be a long trade, but you can still, you know, trade whatever way you like. But that's the idea behind the trend line. Okay, now when drawing the trend lines, make sure to at least connect two tops. Your trend line should touch at least two tops of the price, okay, and if it touches three, that's better, and even stronger confirmation that yes, you are in a strong trend. So that is the idea about drawing the trend line. Okay, now in this scenario we are not going to use just the trend line alone. We already have the trend line. So here you see the trend line, and at the bottom side you see an indicator, a stochastic indicator. So once you've connected your trend line, okay, now this is a uptrend. The earlier one we looked at was a downtrend. Okay, so the trend line connected price here again, price here at all time, and also price here. And don't try to force it. Don't try to draw your trend lines inside like this, like this, like this. No, the tip is enough. Okay, if your trend line touches the tips of the wicks, that is enough. And what do we have here? Instead of price to continue to bounce off the trend line to the top side, what did we see? Price broke the trend line, came back for a retest. Here is a retest, and price continued to fall down. Now, if you had seen this breakout or break of a trend line, and you also have your stochastic indicator right here, you will see that the stochastic opened so wide, and that shows us what, that there's a lot of volatility. And look at this stock, this movement to the downside. Okay, look here, all this, okay, to the downside. Now before it to get here, you already know that the movement has passed already. But see the area where it is cycled yellow, that is a move, that is a breakout. Okay, so take your trade. Now this is the breakout of a trend line. I hope you understand this, and I hope it's easy for you. But if you don't, please drop a link, a comment in the description. Drop a comment, and then I will explain or do a video to explain better. The next tool we're going to use is learning how to draw channels, and I'm just going to open it here and explain and draw and explain as well. So in drawing channels, it's the same thing as drawing trend lines. So you have one trend line to the bottom side and the other one to the top side, and wait for one or two things to happen. It will either break the trend line to the downside, or it will bounce off the trend line and continue its momentum to the top side. So here we are. Price bounced off here, bounced off here, bounced off again, and again. But do you know the interesting thing about this is that this is a uptrend. Why? Because it's making higher highs and higher lows. Now lower highs rather. This here is higher than this one. This here is higher than this. This here is higher than this, and this one also is higher than this. So this gives us a strong indication that we are also moving to the top side. It is up. Okay, and then we also draw another trend line to the top side, and this tells us what? Okay, this gives us our channel. And so one of two things can happen. Now here in this area here, okay, we see price here. You can either buy or sell, but you shouldn't sell, right? You can only buy here. Why? Because you are expecting the price to bounce off the trend line. But if it doesn't bounce, that's why you should use your stop loss, because you can't predict. If it doesn't bounce, okay, and continues to come back down, it will hit your stop loss and you'll be out of the market. And then you know, okay, it is not going in your direction, it must be going to the other side. What should you do? Wait for it to break the trend line fully, come back for a retest, and once it's going back down to create a new lower low, you enter your trade. Take your trade, and hopefully you ride the trend to the downside. So let's see this scenario. What happened? Oh, we were correct. Okay, so the market prices broke the trend line, came back to a retest, and price fell down. Lower high, lower. There are lots of lower lows anyway. Lower high and new lower lows. Okay, and what did we get from the indicator region? The indicator is showing us that price is definitely moving to the downside. The momentum is to the downside. Look at all this consolidation here, okay, but look at this movement to the downside. So huge, massive. So if you had entered the trade here, fine. If it got here and you could not enter because already the low, wait for it to come back for a lower high, okay, and then enter your trade and ride it all down. So that is that with drawing channels. Now the last one I want to consider is triangles. Now we have three types of triangles. We have the ascending triangle, the descending triangle, and the symmetrical triangle. So how do we draw these triangles? Now when price moves to the top side, okay, you draw a trend line to the top and also connect the bottoms as well, and as well as the top, okay, and wait. Ascending triangles usually break to the upside, so wait for the break. Once price closes above this trend line, okay, inside the market, you can either wait for price to come back down, okay, and then buy the market, the currency to the top side. So this is ascending triangle, and this is how you draw your ascending triangles. You have higher lows and you have a resistance. So once you're able to plot a drawing like this, right, of this triangle, wait for the price to just close above this resistance line. Why is this? Many people right here are selling, believing that the price should come down, but this is the clue that we are having to show and to tell us that price should go up, because we have higher lows, lower highs rather. This low is higher than this one. This low is higher than this one. So since we have lower highs and price is constantly pushing to the top side, we should expect price to break to the top side, okay? So let's consider the next image to see what happens. Okay, what is happening here is that they are explaining to us that the bulls and the bears, they are fighting, okay, in this area right here. So that is that diagram. So there's nothing there, okay? You're not missing nothing at all. And that when they finally fought for the battle, the bulls won. So the bulls broke the trend line to the top side, came back for a retest here. You see that red candle? You see the red candle right here, right? Then price continued to just rally up. So once there is a break and a retest, remember this is a daily chart, okay, take a trade and just leave the trade to run 1 2 3 4 5 days. It might not move a significant movement, okay, but see what happens after like 1 2 3 4 5 6, a whole good whole week of price consolidating in this area. Price finally broke up, you see, broke and moved, rally to the top side. So this is your ascending triangles, and it is always breaking to the top side. Next, we are going to consider the descending triangles. The descending triangle is usually the reverse side. So see this, how it works. Descending triangles consist of lower lows and lower highs, okay, and a very strong support. So how do we know that the prices will break to the downside? Because we have support holding, however we have lower lows coming, lower highs forming as well. And this should tell us that if it is actually going to, if the support is actually going to hold, price should break above this trend line to the top side, okay, break above the lower highs. But it's not doing that. It keeps falling back down to the support, and we should expect that in a descending triangle, price usually falls to the downside. Price breaks to the downside in the descending triangle, which we have here, okay. So let's look at the next chart to see how our price of the market went. Either it broke down or not. And obviously, as you can see, price broke the bottom trend line, okay, and it came back for a retest before price continued to slump down. So here is our descending triangle. I hope you understand this. If you do not understand this explanation, please drop your comment or ask your questions on the comment section, okay. Now the next one we have is symmetrical triangles. Now symmetrical triangles have no absolute direction in which they will break to. So once the symmetrical triangles are forming, draw your trend lines to connect your lower highs and your higher lows, okay. Once you connect your lower highs and your higher lows, the next thing for you to do is to wait, because price can either break to the top side or price can either break to the bottom side, okay. And this is why it is called symmetrical triangle. You do not know. Wait for price to break. And how are we to understand this? The next diagram will explain to us. Now take a look at this diagram. Okay, we are still here. We are still saying price could break out on either side, up or down. So this is not what we want to look at. What we want to look at is to see if price broke out, okay. Now here price broke out in this instance to the top side. So see what happened. And if you had waited for a retest, okay, before you buy, you wouldn't have seen a retest. This is what we were learning at that time, that sometimes the downside to this is that price can just break out and continue to find its momentum to the top side or to the direction in which it is going, either up or down. The previous examples we saw, you see a red candle coming back down, that's the retest, okay. But in this scenario, what we'll have, the breakout, okay, and price just continuing to rise to the top side. So once you had waited for the breakout to occur, okay, enter. This is our entry here. Here is our entry, okay. Take a trade, let it rise to the top side. So this is one instance whereby the symmetrical triangle broke to the top side. If it were to break to the downside, see where your entry should be, okay, a short entry. I believe you understand what the symmetrical triangle is. Now, breaking down the triangle breakout, ascending triangles usually break out to the top side. So when thinking of the ascending triangles, think of breaking out on your forehead. Ascending is going up. Now, descending triangles usually break to the downside. So when you think of descending triangles, think of breaking out on your chin. Now, symmetrical triangles, on the other hand, can break either way, to the upside or the downside. So when you think of symmetrical triangles, think of breaking out on both your chin and your forehead. Try to have this mental description on your mind all the time, and it will be easy for you to spot them out and to know the direction. Ascending is to your forehead, descending is your chin, and symmetrical is either ways, to your forehead breakout or to your chin breakout. Now let's move to the next lesson, how to measure the strength of a breakout. So as we have learned earlier, if a trend moves for an extended period of time and it starts to consolidate, one of two things could happen. Price could continue in the same direction, which is continuation breakout, or two, the price could reverse in the opposite direction, which is a reversal breakout. Now, there are ways in which we can measure the strength of a breakout. Now, one way to do that is to use a technical indicator called moving average convergence divergence, or simply put, the MACD indicator. Now, the MACD indicator has many ways you can use it, but one of the sexiest ways to use the MACD is to look at its histogram. Now, what the histogram does is show the difference between the slow and the fast MACD line. When the histogram gets bigger, it means momentum is getting stronger or volatility is high. When the histogram gets smaller, it means momentum or volatility is getting weaker. Now, here is the MACD. Here, momentum is low. That is what the histogram is showing us. Here, momentum is also low. However, in this area here, the MACD histograms are very, very huge, and this tells us that the momentum is high. And what do we see? Price is rallying to the top side. So that is how you look at the MACD and use it to measure volatility in the market. Also, remember that trading signal we talked about earlier, okay, which is called divergence, and how it occurs, okay, and how we can use the spot price direction. So since the MACD shows us momentum, it would make sense that momentum would increase as the market makes a trend, right? Yes, it should make sense that way. So if you can deduce that momentum is decreasing and the trend is decreasing, you should also be able to deduce that the momentum is increasing and the trend is increasing. And how do you do this? Through the histogram, the highs and the lows, or the big and the small of the histograms. And here we go. See, why the histogram increased here, right? What happened? Price fell down, okay? And while the histogram is decreasing here, although it's in the same trend as well, right, to the downside over here, price also continued to fall down. So what do we see from these huge histograms? We see huge fall in price. That is how you use the MACD histogram to know or to deduce that momentum is increasing or decreasing. And once the histograms get to contract as smaller, you can begin to understand that the momentum was beginning to fade out and there's also going to be a reversal, because if it's not going to fade out, it should continue to push or print huge momentum histograms for us. Now the next indicator we can use to measure momentum in the market, okay, the measure momentum of the breakout in the market, is the RSI, the relative strength index. Basically it tells us the changes between the high and the low closes of prices in a given time period. So we're not going to talk about how we impute it. If you go back to momentum indicators and oscillators, you'll find the oscillator, you'll find the this indicator discussed in that video. So how can we use the RSI? Like the MACD, we can use it as divergence. Okay, so what did we say? If the price on the chart is printing higher highs, higher low, higher high, higher low, whereas the MACD, the indicator is printing lower highs and lower lows, we should know that it is called divergence and price is about to reverse, okay, from the top to the downside. And what happened? Price actually fell in the price, and price continued creating the lower highs and lower lows on the RSI. That is how you use the RSI as divergence. Of course, you should also remember that the RSI has two figures, which is the 70 and the 30 level. Okay, once price is in this region of 70, it shows that price has been overbought. Okay, overbought. Price should fall down. The bulls have ridden the market so long and price should fall down. However, when price is in the region of the 30, it shows that the price is oversold and price should rise up. That's basically how you read and you understand the reading of the RSI. Okay, so because trends are movement in the same direction for a given period of time, you will often see the RSI in the overbought or in the oversold region. Okay, so if a trend has produced oversold or overbought readings for an extended period of time and begins to move back within the range of the RSI, it's a good indication that a reversal is imminent. If price has been in the overbought region for a long time, as you are seeing here as I'm marking out, moves away and comes back to that same region again, you should know that something terrible is about to happen. And what is that? Reversal in the market. And what do we see from charts? Right, look at price action. Price is falling and price did fall, and price did fall in the indicator region as well. So it's simple as that. Try to know how to put these indicators on your chart and trade accordingly. Now, this is all we are going to take for this section, which is how to measure the strength of a breakout. Next lesson is how to detect fake outs. So here we are, how to detect fake outs. Breakouts are popular among forex traders, and it makes sense. Okay, everybody wants to enter the market once price breaks out of an area of consolidation. Okay, now, so when you see price breaks out, it's not important for you to just jump in then. Why? It is good for you to wait. In this diagram we're looking at right now in the chart, we see the 10 EMA acting as resistance. Okay, and price broke below the resistance and fell down all the way. Okay, fell down all the way below the resistance, which is the red line, the red EMA. And what do we see? Price broke above here and even closed stronger and higher. Okay, so if you're using this, one could say, okay, it's time to buy, but it is important for you to wait. Once you spot the breakout, wait to see price inch in one direction, then suddenly move miles in the opposite direction. It happens. See what happens here? Price moved, broke the resistance, okay, away. And if you had bought, maybe you didn't protect your entry, what would have happened is you see price come up and all of a sudden come back down and down and down. Look at this guy here. That's how you'd be screaming then if you had entered wrongly. Okay, so it is always important for you to wait for price to really go in the direction of the trend. Don't just jump in and buy. Now, support and resistance levels are tricky. Always remember that, and especially it's an area, it's not actually a line. Many people will draw lines on support and resistance level, but it's actually an area. Okay, so it's area where buying pressure is just enough to overcome selling pressure and halt or reverse a downtrend. It's an area. And also resistance level are the same way. They are also an area where price is just strong enough, okay, to overcome the buying pressure and force price to break and to fall back down. So strong resistance levels are more likely to hold up even the price temporarily breaks the resistance level, and it provides traders a good selling opportunity. Do you understand what we just read? Strong resistance level are more likely to hold. So if this is a resistance, okay, if price even breaks it, it is more likely to hold. It doesn't matter if price comes up. What can happen is that price will come back down, okay, and go down. So that is the reason why it is advisable to be patient, hold, and this is the way in which you can avoid fake out. The same way with support levels, okay. Fake out will come, price will break, and you think, oh, it's time to sell. It broke, this level did not hold, and all of a sudden you see price coming back down, coming back up rather, again break into it. It happens many times in the market. So it is not enough learning about breakout strategies, because there are many times these breakout strategies they fail. So what we have to do now is to be able to understand fake out and what to do when those cases arise. So this is part of your JD Forex trading. To be a JD master, you must be able to master fake outs. Are you up for it? Let's continue to fade the breakouts. So fade the breakout. Fading breakout simply means trading in the opposite direction of the breakout. Fading breakout equals to trading false breakout. If you know the breakout will not be able to sustain or keep the momentum to the upside, what you do is trade the opposite direction. Yes, we know once the price breaks above a support or a resistance area, right, we are out to buy. But that's what the majority of people do. So in fading the breakout, we do the opposite direction. So in fading the breakout, we do the opposite thing. Instead of buying, right, we sell. That way we are fading the breakout, because we believe the momentum would not be sustained. In fact, many of the time, right, the momentum of the breakout is not sustained, especially with markets where nothing is guaranteed, and especially with the market where the more seasoned players, the institutions, they are ready to take the money of the less experienced traders. So keep in mind anyway that in fading breakouts, even though it's a great strategy, it's a short-term strategy. Again, fading breakout is a great short-term strategy. It is not a great one to use for long-term traders. You must have that at the back of your mind constantly. So trading breakout appeal to many forex traders. Why? Because support and resistance levels are supposed to be the price of the floor and ceilings. So if these levels are broken, one could expect that price will continue in the same direction that the price broke. And also, if a support level is broken, that means that general price movement upward or downwards is more likely. So there are more sellers than buyers. So it is interchanging. However, it doesn't always work like that. Independent retail traders have greedy mentalities. The big boys know this. They believe in trading in the direction of the breakout. That's what retail traders do. And they also believe in huge gains on huge moves. They want to catch the big fish and forget the small fish, right? However, that doesn't happen in the perfect world. where frogs and princesses do whatever they want to do and live forever after. In fact, there's no happy forever after in the forex market. Okay, nothing is certain. So what does that mean? Breakout fails simply because the smart minority has to make money off the majority. Don't feel sad about this, okay? That's what happens. So the smart minority comprise of the big players with huge accounts, and they buy and sell huge orders as well. So in order to sell something, there must be a buyer. So if everyone is buying, or if everyone wants to buy at resistance and at support level and what have you, right? What do the smart minority do? They are not fool, okay? They are the market makers as well, okay? So they go against you. And because they have huge account that controls billions of financial security, right? Your thousand, your few hundreds, your few 20 bucks or 50 bucks or 100 bucks will not be able to withstand the huge billions of orders that is coming against you. Okay? So the best thing to do, okay, is to go in the direction that the smart boys are going. Follow in the direction, okay? So the smart minority, they comprise of the institutions, the more seasoned traders. They prefer to fade breakouts, okay? That's what they do. So they take advantage of the retail traders, of the crowd, of the inexperienced traders, and they win at their expense. That's why trading alongside the more experienced forex traders could be very, very profitable for you. So which would you rather be part of? The smart minority that fades breakouts, or the losing majority that gets caught in false breakout? So let's now see how to fade breakouts. In the next lesson, how to trade fakeouts. So here we are on how to trade fakeouts. So in order to trade the fakeouts, you need to know where potential fakeouts can occur. And there are three areas or three places where potential fakeouts are usually likely to occur: support and resistance levels, trend lines, chart patterns, and especially more so previous daily highs and daily lows. So let's consider the first one, trend lines. In fading breakouts, usually remember that there should be a space between the trend line and price, okay? For example, the chart below, there's a space between the trend line and price, which allows price to retrace back towards the trend line, perhaps even breaking it and providing feeding opportunities. Now look at the shadow we have and see if you can spot the fake out. Look at this candle here. It popped up, broke the trend line, but it did not continue up. This is the fake out, and we can fade this trade by taking an entry here, no, not there, somewhere here, and take profit here once a new low is created, okay? And so these are the areas where fake outs are especially more likely to occur. Look at this one. It's so terrible and convincing, okay? It even came back down to retest the trend line before breaking back in instead of breaking out. So this is a huge fake out. And another one, but even before we draw the cycle, see how price acted, broke the trend line to the top side before finally falling back down inside the trend line. So why do all this happen? The big boys, the retail, the institutions, they know that retail traders are, are drawing all this. They know how retail traders trade. They know how you and I trade. They know what is running through our minds. So they create all these moves. They make it. They know we know the trend is to the downside. But for there to be sells, there must be buyers. So they create the buys. Okay, how do they create the buys? By going in this direction, making you believe that yes, it's breaking now. So they create all these moves to the top side. And once they have seen orders, because they can see your orders and our orders, we just can't see theirs, but they are seeing our orders, all the orders that brokers are pouring into the market. They see them, they know your direction, they know our direction, but we do not know theirs. Okay, they have the highest algorithms. They in fact, their trading machines, they trade with supercomputers. Okay, so everything is so fast, so everything so happens fastly in front of their eyes. So in a second, they make huge things happen. Huge money run through their account. They execute billions and trillions of orders. Okay, so they are the ones creating all these fake movements. And once they have created it and they have seen that many people have entered the trades here, what happens? Like you see, a week happen. Week occurs, a huge week occurs. This huge week occurs because they pull out orders, they buy orders, or sometimes they let the buy orders in, and at other times they just, you know, pull in huge orders. I mean, sell stop orders, so to say, here around this area, and they close their buy orders once it's a break even, and they enter sell orders. Okay, any way they do it, I just don't know. I can't tell you how they trade, but we can understand how they trade from the chart. They are the one making all those moves. Now, another way to know that a fake out or a breakout is fake or it is real. In this case, it is fake because it came back in, right? All of it, all the orders, it came back in. Here came broke out and then it came back in. Here it broke out and then it came back in. So all these are fake. Okay, now there are some that are not fake, they just continue up. So how do we identify that? Look at this trend here. I'm not going to be reading. Okay, see the trend line we have drawn. Okay, we've drawn the trend line. Now once you see price closing so bullish, okay, look at this bullish, huge bullish candle rather, and price also closed so bullish above, breaking the trend line. Okay, that should tell you that the bulls are in the market. This is not a fake out. Okay, this is actually a bullish momentum, and price is definitely going to continue in the direction of the breakout. Okay, and what do we see? Price broke up to the top side, and so yes, that is how to identify a breakout that is sustainable and is not a fake out. And we can also, once we have identified and spotted the fake out, we can be able to take entries. And so after this huge week to the downside, showing that sellers are still in the market, we allow for a huge bullish candle, bearish candle to the downside, and we'll have our entries in this area here. All this area of these broken rectangle lines is our entry. So wherever you enter here will be a good entry for you, and here's your take profit. Price move back up again, create a double top here, it could not come to the trend line, you can enter here again. Okay, do the same thing over and over and over again. Now I hope you understand that. So let's move on quickly, because this video is now getting up to an hour and I don't like that. Chart patterns, another scenarios whereby fake out occurs most of the time, it is true chart patterns. And there are two commonly known chart patterns that these institutions they use to fake people out, and one of them is head and shoulders, and the other one of them is double top and double bottom. And they know how you and I will trade as well. Okay, the retail trader, they know how we trade. They know if there is we know, they also know that once we spot a head and shoulders, we are more likely to enter a trade. This is the neckline. Okay, we'll put our entry here and we'll place our stop above the neckline. I mean, that is what many of the gurus out there on YouTube they teach, right? And that is what I also learned this. I got burnt many times when I spotted head and shoulders, and I said, oh, this is the right shoulder, this is the left shoulder, this is the head, this is the neckline, I want to enter here. You enter here, what happens? Price goes up and knock you out and continue to ride up. What is happening? Fake out. What about double top or double bottom? Okay, price come here, this is the double top, this is the neckline, we are told to enter here, put our stop loss here, and price comes down and all of a sudden it goes back up, smashes out of the market, and price just continues to rally to the top side, right? That's double top. What about double bottom? The same thing. Okay, instead of price to come back down once we have entered here, sorry, let me do this again. Okay, this is double bottom, right? And price just continue to fall down. It happens many times, perfectly or imperfectly. I hope you understand what I'm saying. Don't mind where I draw whatever it is I'm drawing there. So let's look at some live examples. Here is an inverted head and shoulder. Okay, here is an inverted head and shoulder. Okay, usually once we have spotted the inverted head and shoulders, this is the neckline. We are told to enter here, place our stop loss here. Okay, this is the left shoulder, this is the head, and here is the right shoulder. Okay, so let's look at the next chart to see what the institutions they did. So they have seen all our orders and all your orders as well. They see our neckline, they have seen our entry and our stop loss, and what did they do? They push price down. Price came back up again to create another double top here, and they push price down, and and price just continue to fall down. And what did they say? All your pips belongs to us, baby. It happens. This thing happens many times. And let's take a look at what is it called now, a double top, and see what many of us retail traders do. Okay, and how we can learn. So here's the first top, second top. I mean, we learned about all this. Babypips even taught us this, right? And so we are told, put your entry here, your stop loss here, because it has broken the neckline already. Here's the neckline broken. And so now we have taken our trade. Let's now see what the institutions they did. Okay, open up. Okay, this picture is bad. So the institutions came, they have seen our orders, okay, and they said, okay, they have entered here, their stop is here, let's just push it down a little bit and then go to the reverse side and continue. And so they wipe us out. All our money belongs to them, and they've gone. That is what happens, my friend. So financial markets spend a lot of time bouncing back and forth between a range of prices and do not deviate much from these highs and lows. Okay, so ranges are bound by a support level and a resistance level, and buyers and sellers continually push prices up and down within those levels. So fading the breakout in these range bound environments can prove to be a profitable trade for you. However, at some point, one side is eventually going to take over and the new trending stage will form. With that, we are moving to the summary of this grade. So trading, breakout and fake out summary. So in trading breakout, the goal is to enter the market when price makes a breakout and then continue to ride the trade until volatility dies. Breakouts are very, very significant to know. Breakouts are significant because they indicate a price change in supply and demand of the currency pair, right? So you will also notice that unlike stocks, what we have learned so far is that we have volatility. In the stock market, it is volumes in which they use to measure breakout, but in currency market, in FX trading, it is volatility that measures the overall price fluctuations over a certain time, and this information can be used to detect breakout. Now, chart indicators to measure volatility. Moving averages, Bollinger Bands, average true range chart indicator are what we can use. Types of breakout, a continuation and reversal breakout. To spot breakouts, look at chart patterns, trend lines, channels, and triangles. How to measure breakout strength. You can measure this by using the MACD and RSI. Also check Forex calendar and news to find out whether or not a breakout trade is the right play for the situation. Trading fake out. Institutional traders usually like to fade breakouts, so we must also like to fade breakouts as well. Okay, we don't want to follow the crowd. Think, act, eat, sleep, and watch the same movies as these guys do. If we can trade in the same way the institutional players do, success is just a glimpse away. Fading breakout simply means trading in the opposite direction as the breakout. Okay, so potential fake outs are usually found as support and resistance levels created through trend lines, chart patterns, or previous daily highs or lows. The best results tend to occur in a range bound market. However, you cannot ignore market sentiment, common sense and other types of market analysis. Financial markets spend a lot of time bouncing back and forth between a range of price and do not deviate much from these highs and lows. Finally, the odds of a fake out are higher when there is no major economic event or news catalyst to shift forex traders' sentiment in the direction of the break. With that, my friends, we come to the end of grade 11 that talks about trading breakouts and fake outs. Congratulations for moving ahead. Share this video with your friends and family and loved ones, anybody who you know can make a living off the sidelines of trading forex. Okay, and if you haven't already, smash the like button for me, my friends. Subscribe if you haven't, and until next time, take care.